Now joining us for this panel are Washington, D.C.-based economists Dr. Mohammad Reza Jahan-Parvar, Dr. Mehdi Beyhaghi, and Dr. Borghan Narajabad, which will be moderated by Dr. Siamak Javadi.
Thank you again. So with my colleagues, we're going to discuss these two papers, financial markets and the banking system, a little bit more. I'm going to start with Mohammad. Mohammad, what do you think are the most salient feature in terms of the financial markets and the banking system immediately after the collapse of the Islamic Republic?
Thank you very much, Siamak. So starting with, it's a super important issue to put forward. Right after the collapse, there is a concern that, as you mentioned, that you may have the case of either fire sales or market freezes, and the currency situation, essentially the exchange rate management becomes to the fore. Keep in mind that right after the collapse of right after the transition, there is this demand. There's a popular demand for the central bank to control inflation. In order to do that, it needs to be able to set interest rates, even if it doesn't have a constitutional mandate. The second part is that a pillar of the monetary policy, essentially fiscal and monetary policy of the Islamic Republic, has been intervention in exchange rate market. So although Siamak showed that Iranian rial has steadily lost value against major trading partners' currencies, one feature that you notice is that they try to suppress the fluctuation in this market until suddenly you have a jump. And this essentially, it is as if you are putting pressure on a spring. You keep it, and eventually you can't do that and it jumps. And that introduces a lot of uncertainty in the market. The issue that you want to do is that you want, and on top of that, it drains, supporting such a mechanism, drains the resources of the economy. Essentially, the little hard currency reserves that you have to actually devote that to maintain these interventions. So for the transitional government, it is super important to abandon this policy, essentially allow markets to decide the correct exchange rate. Given that, once the pressure of a confrontational foreign policy is removed, a lot of uncertainty about the future of Iran's economy will be restored. So the expectation may not be the constant devaluation. It may be actually more attention paid to future growth. Now, that requires that at least for the short term, and potentially even for an extended period, until the legal issues of corruption and asset stripping or other shenanigans of institutions related to, for example, IRGC or the Supreme Leader's apparatus are resolved in courts of law, the government needs to at least monitor and potentially control the flow of capital outside the country. That's going to be a popular demand. It also makes economic sense. Taking all that into account, abandoning the defense of these crawling peg, or essentially constant current intervention in the exchange rate market, that's going to be an important issue that would help the central bank to focus on reduction of inflation, which is going to be the underpinning, the dominant feature of economic policy in order to build trust, such that the other legs of the policies that you mentioned can be built in. So thank you very much.
I would like to add something to you just mentioned. This exchange rate system in Iran, we have these parallel markets, right? We have the preferential exchange rate, multiple of them. It seems this is not done due to lack of knowledge. This is just giving out rent itself is a manifestation of corruption. So can you explain a little bit about that?
So, the general thing that we know is that there are three parallel exchange rate markets in Iran currently. At some point, there used to be about 8. That was removed about a decade ago. But what you have is that you have the free, you have the black market rate, you have the so-called preferential Nima rate, and then you have the official rate. And the gap between these markets can be quite large. The official rate essentially is unattainable. You can only access that under certain circumstances. The Nima rate is the main policy rate, such that exporters or importers can access their revenues and repatriate them. And for the general consumer, the free market rate, the one that actually has large fluctuations, most of us are familiar with, that's a market that people look at. Now, the problem is that the differential values across these three markets opens up a lot of rent-seeking opportunities, and it has been one of the driving forces of corruption, depending on who has enough connections to access which market throughout the country. So I think that...
Yeah, it's a get-rich-quick scheme for a lot of people with connection. It is. That's the way it is, really. Now, turning to you, so what do you think are the salient features in the intermediate term after the collapse?
Yeah, so let me begin by addressing two salient issues, both with the banking and financial system, as well as to some extent with the fiscal condition of the government. First, as you mentioned, Iran has around 35 banks. Nearly all of them are burdened by balance sheets repleted with non-performing loans. These loans are from almost bankrupt firms, municipalities, state-owned enterprises. And on top of that, most of these banks have taken ownership of numerous bankrupt companies after those companies have defaulted on the loans from those banks. You mentioned basically Bank Ayande, Future Bank, and the famous cases like how Iran Mall was bankrolled for more than a decade and finally was acquired because it was a bankrupt project. But this is very common across the board. Now, given the persistent stagflation of Iranian economy in the past decade or so, basically we have many companies which are practically zombie companies. And the only way that these zombie companies continue to survive is by rollover of their debt by the banking sector. Now, this practice has in turn pushed almost all Iranian banks into insolvency. Now, how do these insolvent banks continue to survive? Basically, their survival depends on the continuation of this sustained high inflation. In a sense, this high inflation allows these banks, as you discussed, because of lack of proper accounting practices, this high inflation allows these banks to continually reevaluate the book value of their acquired bankrupt companies at higher prices, and at the same time paying basically significantly negative real interest rate on their deposits. So this is where we are in terms of our bank sector. In my mind, this is the most salient problem that we're going to be needing to deal with.
So what do you think can be done? What do you
But
think
before getting to that, I want to also emphasize that this is just one aspect of it. The other aspect is that basically we have concerns about government's fiscal conditions, as Mohammad mentioned, and you touched upon it as well. This year, basically about a quarter of government's budget is expected to be funded by issuing new debt. That's double the proportion of debt financing which was last year. So obviously, this is a clear example of lack of fiscal discipline. But the surprising part for me has been always that despite this heavy reliance on sort of debt funding, Iran basically sort of lacks a proper government debt market. In a sense, basically, most of government debt is forced upon banks or pension funds if they are not directly absorbed by the central bank's balance sheet. Put simply, in Iran, our primary debt market lacks an effective price discovery mechanism, and the secondary market for the government debt is virtually non-existent. So this is also the other aspect of flow of credit in Iran. So we have banks which are rolling over these bankrupt firms, and we have a government which is relying on debt financing, but there's no functioning market for this debt financing.
Yeah, I would like to add one thing to just put it in context for everybody. Like Borghan was talking about the rollover losses and how they, push the can down the road. Just to give you some idea, the situation is that the bankrupt banking system of Iran is forced to provide mandatory facility to the auto industry that is bankrupt itself. So like the accumulated loss of the two major manufacturing companies in Iran, Saipa and Iran Khodro, is larger than the official budget of IRGC annual budget. It's a massive loss. They are not making money. So you have an auto industry that is bankrupt, you have a banking system that is bankrupt, and banking system is providing finance to this industry, mandatory finance. And then this is like a large asymmetric issues, conflict of interest. Who gets all the benefit? The CEOs of these companies and the banks and the auto industry, and who gets the costs? The public in terms of inflation. Now, Mehdi, in the long term, what do you think are the most salient features?
Thanks. All right, sorry about that. Okay, now I can hear myself. So, um, I can look at long-term challenges from domestic and international perspectives. From domestic perspective, financial inclusion is going to be a major challenge, and ultimately that's one of the goals of the banking system is financial inclusion, right? So from what I understand right now, credit allocation is not sufficient. An average person struggles to get a mortgage to buy a house or get a credit card or basically get affordable loans, right? Not only credit allocation is not sufficient, but also it's inefficient, opaque, and often unfair. As you mentioned, lending, especially to businesses, is often based on connections rather than merit, right? So this does not only hurt individual prosperity, but also it deepens inequality and it constrains economic growth. From international perspective, I think the trust in Iran's banking system is low, and there are good reasons for that. You mentioned some of them. You talked about accounting practices being outdated. I can add to that that the central bank lacks full authority to supervise banks effectively. So you see that numbers cannot be trusted when non-performing loan rates are high, yet banks continue to report profits. So when numbers cannot be trusted, earnings are overstated, losses are understated, assets are quite mispriced. International banks are not gonna trust to fully engage with these domestic banks, right? And this has important implications for whether it comes to Iran's ability to trade, to attract investments, and ultimately to grow. So these are, I think, the long-term challenges. And so I think to overcome these challenges, several key steps need to be taken. First, I think the most obvious one is Iran should comply with anti-money laundering and financial transparency accords, FATF in particular. Then this allows Iran to gain access to international payment systems, SWIFT, and ultimately gain access to global markets. Second, I think it's important for Iran to adopt and implement Basel III standards. So this means Iranian banks need to be better capitalized, better quality capitalization, stronger liquidity management, improved risk governance. It also requires strengthening the supervision of banks by the central bank or other authorities, updating the standards, training bankers, regulators, bank examiners, taking supervisory actions when necessary, including resolution of a failed bank. So also it's important to know that being healthy in normal times is not enough. You need to be prepared for future adverse scenarios. So this requires a stress testing, orderly and periodically, especially for bigger banks. I just want to emphasize that, like Basel III and the standards like that, this is not just a checklist. This is a global common language of trust between banks. So if international banks and investors see that Iranian banks comply with Basel III, then they gain confidence to interact, to trade, to invest, and basically provide capital.
Let me interject here, just for reference to the public. So the Basel III requirement is, well, what's the percentage for capital adequacy ratio? It's about 8%, right?
So Basel III, yes. So there are different capital required depending on the type of capital. I don't want to bore the audience.
No,
with
I
the
know.
technical
I know.
details.
But the point I wanted to make is that the average of this ratio in Iran.
So with Iran is much lower than the what Basel III, and even those numbers might not be trusted because some of the numbers are, as I mentioned, you mentioned the accounting standards are, so some of those are different. And I just want to emphasize that there's a fine line between regulation and flexibility. So regulation should not be too restrictive. I don't want to get to too much technical detail, but there's a fine line between having safe and sound banking system and financial system and being able to innovate and grow and invest over time. So when you take all these measures, when we become more transparent, modern, aligned with global standards, I think Iran can transform its banking system from a fragile state to an engine of prosperity. And that's very important to unlock full economic growth. And in fact, I just want to close with that in fact, I think with the right reforms, Iran can join the club of G20 countries and play an important role in the global economy.
Thank you very much. I guess we can conclude the session unless, do we have time for questions? How much time do we have? We have 5 more minutes? Yeah, okay.
Islamic finance. What is Islamic finance?
What is Islamic finance?
Yes.
Yeah, that's a good question. So Islamic finance is not mainstream in the field of finance. It's on the fringe. It's becoming more popular now. Academically, you look at the academic journals, there are not a lot of papers on it. But what it is that it's based on Sharia law. It has basically, if I remember correctly, 3 principles. The interest, bahre, riba, is prohibited. Any transaction should be involving an actual physical asset. So that means when you conduct monetary policy, and you change the interest rate, which is technically only for profit making in a sense, although the ultimate objective is not profit seeking, but it's the implication of it is that the effect of it is going to be profit making for market participant. That is prohibited. And then another implication is that you're not going to have the derivatives market, like you won't have like options market, forward market, futures market in that sense, because they consider this to be a gamble, a speculation. So Islamic finance it has the potential to amplify business cycles. So imagine a situation where you have this fluctuation in currency and the corporate sector does not have the tool to manage that risk, to hedge that risk. And as a result, what happens is that they have to pass on that risk in terms of price hikes and price fluctuation to end consumers. And that would affect consumer consumption, and that means the fluctuations in the economy is not managed, it's directly transferred to the end consumer, to the real economy, and that is not good. Still have time, right? Any other questions?
If we have time, you know, I wanted to basically touch on the transition period a little bit more, because Mehdi rightfully laid the ground for what we need to do in long term, in future. And Mohammad talked a little bit about, you know, what we need to do right immediately, particularly in terms of the exchange rate. There is a little bit of a gap there between, you know, what are we supposed to do once we have somehow, as you rightfully mentioned, we have prevented the immediate bank run, and you know we have stabilized, let's say, the exchange rate. What is the objective going from that stage of, let's say, the first 3 months to then, you know, longer horizon? Now, during this period, we only have the banking sector that we are going to inherit out of this mess. And as I mentioned, you know, this banking sector is highly problematic. And on top of that, we have a government which is going to be basically relying on still continuing its debt financing. Now, the second part is relatively straightforward. You can, you know, rely on various experiences across the world in terms of setting up a fully functioning primary and secondary government debt market. The first one is going to be very tricky in terms of, like, you have all of these banks which are sort of lacking any proper accounting standards. And if we go out there and say, look, you need to cut the flow of credit, all of a sudden, all these firms, all these zombie firms, they are going to be facing a very severe shock. And a lot of them might be forced to either basically engage in fire sale of their assets, which, you know, as we know, particularly given their these firms' corporate structure with various, you know, Islamic Republic cronies taking ownership of them, could be detrimental. Or they try to basically seek some type of non-bank financing, which obviously, when you don't have a proper credit market for government debt, you know, it's not hard to imagine that you can't have a proper private debt market. So then the question becomes, how can you continue flow of credit in, let's say, in the, you know, 1 to 2 year horizon between going from like immediate aftermath of a collapse and then, you know, immediate stabilization until, you know, getting to a, you know, sort of a long-term type of reform. And my suggestion for that period, and it's a tricky, it's just a starting point for discussion, but it's a very important discussion that we need to have, is to sort of prevent banks from extending extra credit to the to their already borrowing, you know, heavily borrowing companies that some of them are actually owned by those banks, and forcing these companies to seek extra credit from other banks. So this is the minimum we can do so that we impose some type of financial discipline on these sort of almost bankrupt, or in some cases bankrupt companies, without forcing them to sort of engage in fire sale. Otherwise, if we go out there and say, okay, look, banks are in trouble, they shouldn't be lending anymore, particularly for the companies that they are already, you know, some of them are owned by these banks because they have already defaulted, or, you know, they have non-performing loans. If we go out there and do this, then, you know, it's going to be a drastic outcome. Again, I'm just laying out the big challenge out there, and my suggestion, as I have to emphasize that it's by no means a final word on this, is to say that, look, we might be thinking about forcing these firms to engage in reaching, you know, credit, asking for credit from other banks, and in that process, we basically reestablished better accounting, better, you know, financial discipline. And this way we can go from like immediate aftermath of the collapse, which at that stage, you know, we don't need to worry necessarily about like, okay, what's going to happen for like 1 to 2 years, to, you know, to a condition that, okay, now, you know, we have stabilized, we have some flow of credit, these firms did not engage in fire sale, and now we can implement long-term.
Yeah, absolutely. This is a very critical point. Do we have?
What about those LCs that maybe are already issued based on borrowed money? And those would be one of the first ones that could be essentially a means of transferring funds, especially funds that they are not backed up by actual dollars, but borrowed money. Is any strategy set up just to make sure those LCs are canceled?
So basically, you know, that touches on the discussion that Mohammad and Said, you know, talked about it. Right now, Iran has a substantial amount of frozen financial assets outside, and if we manage to basically unfreeze some of those assets, then, you know, we would be able to deal with these LC problems properly.
All right, I think we can conclude the panel. Thank you very much. Thank you very much for your time.